Okay, let's take a look at this lessor entries problem with a sales type lease. Crosley Company, a machinery dealer, leased a machine to Dexter Corporation on January 1st, 2007. The lease is for an 8-year period and requires equal annual payments of $35,013 at the beginning of each year. The first payment is received on January 1st, 2007. Crosley had purchased the machine during 2006 for $160,000. Collectability of lease payments is reasonably predictable, and no important uncertainties surround the amount of costs yet to be incurred by Crosley. Crosley set the annual rental to ensure an 11% rate of return. The machine has an economic life of 10 years with no residual value and reverts back to Crosley at the termination of the lease. And we need to compute the amount of the lease receivable, and they've even told us to use Excel's present value formula. But you could certainly use a calculator to do it, or you could use present value tables as well. You could even find an online calculator to help you. Alright, well, let's first determine the present value of the lease receivable. Okay, so it says use this area, and I'll do that. We need the present value function. I'll type in PV left paren, and then I'm going to go up to the formula bar, which you can't see, but it's right above there on the screen. Let me click on that, and it will call up the function arguments, which I'll slide over so now you can see. Okay, so it says where's the rate, and the rate is given in that cell, 11%. So I'll bring that down. Number of periods was, let's see if we can move this, was 8. Bring that down. The payment amount is the $35,013. So let's bring that down. And the future value represents how much is this worth at the end. So it's really worth 0. We want to calculate what's the present value of all of it today. So you can either enter a 0, which I usually don't do. I usually just skip it. And then we need to indicate whether it's normal, which means it's a normal or ordinary annuity, which case, again, 0 or plain. But in this case, I think the payments are made at the beginning. Yeah, the beginning of each period. So we need to give it a 1 to let it know that it's an annuity due. And once we do that, we're able to calculate that the present value is equal to $200,001. Now it's negative because we assumed the $35,000 represents inflows. So if that represents inflows, then the value of it today shows up as an outflow. Okay, so the easiest way to turn that into a positive value is just put a minus sign in front of the formula. Okay, so rough and dirty, $200,000. I'll get rid of the cents. We don't need that. 200,001 to round. Now we need to prepare all the necessary entries for Crosley in 2007. Now that we know the amount of the lease receivable, we can record the lease. Okay, now we're going to record what we sold the equipment for, right? It's essentially a sale, right? And that was equal to the $160,000. The sales amount is equal to the lease receivable. And we take the piece of machinery that we had in inventory off the books at $160,000. Okay, so that's the entry to actually record the sale under a sales type lease. Okay, on January 1st, 2007, we also received the first payment. So we would debit cash and reduce the lease receivable. And we would do that for the amount of the $35,013. And then the last entry, at December 31st, we need to record an adjusting entry for the interest rate that that's built into the lease. So we would debit interest receivable and credit interest revenue. And that amount would be equal to the 200,000. Now watch how I'm going to do this. The 200,000 of the present value of the lease. Let me do it this way with parentheses. We'll make it equal to the 200,000 less the 35,000 they paid immediately. So it reduces the present value of the lease to 200,000 less 35,000, and then we would multiply that times the annual rental rate of 11% and come up with what the interest revenue is that's built into the lease. And we need to record that as a receivable and the interest revenue. And that's all we need to do to take care of this particular problem. Thanks, everyone.